And there's no guarantees. These are forecasts. These are not absolute things. Either yes, it will happen or no, it won't.
Right.
When you're making the decision of which product to choose, whether it's variable, adjustable, 3-year fixed or 5-year fixed, you're looking at what are the probability of events.
How's it going, everybody? Very excited today to have this conversation teed up. You saw from the teaser, we're going to be talking about the recent rate announcement from the Bank of Canada. They increased their overnight rate from 0.5% to 1%. Getting a lot of questions about how does that affect people? Does it affect your mortgage currently? Does it affect the decision you should be making in terms of what kind of mortgage you should be getting? Should you be locking in your variable rate mortgage right now, converting to a fixed rate mortgage? We're going to try to answer all these questions, as well as kind of where we see rates going for the rest of the year and how that's going to impact you. So please stick with me on the other side of this intro as we have an awesome conversation all about rates. Hey everybody, how's it going? Rob Marsiglio here with the Robert Marsiglio Realty Group, and we know, big announcement made last week in terms of the Bank of Canada increasing its overnight target rate. Sergei's going to correct me if I'm speaking incorrectly at all right now. He is the expert after all, but it did have an immediate impact on kind of variable and adjustable rate mortgages. And I know I've been getting a lot of questions from clients in the past week as to what should we be doing? Should we be converting to fixed? People looking to get new mortgages, what should we be doing? Variable versus fixed? How is this impacting the market? And what I wanted to do today is bring in an expert, a colleague, a work partner, Sergei Modilevski, who is going to speak more to some of these big questions that you all have. So Sergei, thanks so much for coming on, and how's it going today?
Pleasure, it's going great. Thanks so much for having me, and I appreciate a chance to speak to everyone.
Wonderful, wonderful. So we know the Bank of Canada kind of comes to the table 8 times a year to increase rates or make rate announcements, let's say. We hadn't seen any for the better part of, 2 years? We saw a big dip at the beginning of the pandemic, and then nothing until earlier this year. And then we were hit with, I guess, literally a doozy, a double rate hike, twice the basis points for one is what we saw, Sergei. Like I said in the intro, I've had clients asking lots of questions about how does this impact them right now? How does this impact them going forward? I guess just maybe off the top, some thoughts. Were you surprised by the 50 basis point rate hike? I know it was in the news a lot ahead of time, but what were your thoughts?
Yeah, it certainly didn't come as a surprise. If you had asked me, would we have seen a 50 basis point hike at this time last year, then I'd certainly be I would have been surprised. But this was expected as inflation pressures ramped up when the war in Ukraine began to escalate. More recently, we also saw lockdowns in Shanghai. As a large, obviously, export country, it's got an immediate effect on all parts of Europe and certainly North America as well. So inflation expectations have risen for the short term, and any relief that we expected in late 2022 is now likely off the table. And as a result, we saw 5-year bond yields spike in a really, really dramatic way. And 5-year bonds are basically a leading indicator of what's going to happen with interest borrowing rates. So we've seen that reflected where interest borrowing rates on a 5-year fixed mortgage have jumped from maybe the mid to high 2s to now we're touching just above 4%. So anybody taking a new mortgage moving forward will be borrowing at likely 4% plus on a 5-year fixed. Today, variable rate mortgages are much lower than that though. And today, an average variable rate is likely around 2.5% if somebody's borrowing. And there's certainly an expectation for prime rate to continue rising in the short term.
So talk to me, even just on that point, variable versus fixed in terms of qualifying for those rates right now. We all know about the stress test. For the first time in how long, people are actually having to qualify above 5.25% on a fixed rate mortgage?
That's right. Yeah, once upon a time in 2017, when the stress test was originally introduced, the qualifying rate went from the contract rate, which was your actual mortgage rate, to 4.79%. And the bank would use a qualifying payment based on that rate in anticipation of rates rising in the future. For the last 12 months, the qualifying rate was around 5.25. And that was whether it was a variable rate mortgage or a 5-year fixed mortgage. over the last few months, we've seen the qualifying rate rise substantially. So if today you wanted to take a variable rate mortgage, you'd still be qualifying at 5.25. But if you wanted to take a short-term fix, like 2-3 years, or certainly a 5-year fixed mortgage, you're now qualifying at somewhere in the neighborhood of 6.04. So your borrowing capacity has diminished by roughly 9%, depending on the type of transaction you're doing. So it's a significant jump. And that just means that if you're able to qualify for $1 million mortgage, for example, now you're likely able to qualify for somewhere closer to 900,000.
What are you advising in terms of new mortgage products, and why are you advising that way?
Well, I think you always want to do your due diligence. Everyone has their own unique circumstances, so you want to better understand those through a mortgage planning questionnaire. That being said, there's also 3 predominant mortgage product types, and 2 of them are sometimes conflated. There is a variable rate mortgage where your payment is actually fixed, but when prime rate goes up, what changes is the amortization of the mortgage, which is how much of each payment goes towards interest versus principal. And the interest rate obviously rises as well. Then there's something called an adjustable rate mortgage, where when prime goes up or down, your actual payment changes accordingly. And then there's a fixed mortgage. And if you are locked in a fixed mortgage, then your payment doesn't change at all based on changes in prime rate for whatever duration of time that you're locked in for. And there's no one solution that fits all, but you do want to be extremely conscious when you're making the decision to take a 5-year or even a 3-year fixed mortgage, because there are a lot of implications from it. If you were to take a 5-year fixed mortgage today, you're essentially self-imposing 7 to 8 future interest rate hikes, and you're absorbing all of the impact of that in one day. So you're taking a variable rate mortgage, which today might be, let's say somebody already has a variable rate mortgage, their rate might be somewhere between 1.8 and 2.15 if they locked in at some point over the last 12, 24 months. If you're taking a new variable rate mortgage today, that rate would likely be somewhere closer to about 2.5. If you convert from variable to fixed, you're locking in a new rate today of somewhere between 3.79 to 4.05. Okay. And you will have a materially higher monthly payment obligation immediately as a result of making that choice. Speculating on what will happen with prime rate into the future is very difficult. We have learned that central banks have little reference point to what will happen moving forward. They've certainly been wrong over the last 12, 24 months, originally calling inflation transitory. Banks had underestimated the pace of interest rate hikes when they put out their forecast 6, 12 months ago. So we have certainly been on an escalating path of interest rate hikes, but those forecasts are always subject to change. It's a really dynamic macroeconomic environment. So you have to look at those factors before making a decision on which product's more suitable for you. You do really want to be conscious. If you take a 5-year fixed mortgage with a charter bank, it's not only a matter of interest rate risk and payment risk. You also lose a lot of the flexibility of being able to break out of that mortgage if a variety of circumstances play out in your life. Changes in health status, relationship status, job status, changes in the macroeconomic environment, all those things impact Canadians' decisions to potentially break out of a mortgage. And if you break a long-term fixed mortgage with a charter bank, the penalties can be very, very high. Even within Scotiabank's own paperwork, they warn of penalties that could potentially be as high as 9% of the outstanding balance of the principal of your mortgage. So these are all considerations you want to have before you make the rash decision to react to what likely are short-term circumstances by making a choice that will have long-term implications.
Sure.
So you just want to be conscious of that.
Do you have, I guess, we'll get back to kind of the short term and focus on what we think may happen in the long term. And I know we're not kind of prognosticators, and we may not even want to dabble down that road. But in terms of somebody with the variable rate mortgage who's kind of like, they're not feeling the pressure on their pocket, like you said. If you're in a true variable rate mortgage, your payments haven't changed, just your amortization period has changed, in essence, is what's happened with this rate increase, correct?
Yep, that's exactly right.
What is a strategy for somebody with a variable rate mortgage right now? Let's say they want to kind of hedge against these future increases and want to make sure to, again, there are they have different payment privileges where they can maybe pay lump sums of mortgages, or what can they kind of do to protect themselves against these rate hikes? And in essence, can they put money away somewhere? Like, what's the strategy you recommend?
Absolutely. So I think with the expectation of short-term rising interest rates at more or less certainty, you want to start self-imposing some austerity measures. Start cutting your spending because you know your payment will rise, or the portion of interest that you're paying will rise. So there's two ways to go about that. One is to go into your bank, and your bank will allow you to increase your payment. And you can use a mortgage calculator and quickly determine if you were paying a rate closer to 3.79 or 4.04, what would that payment be? And what's the difference between your current payment and that payment? And increase your payment accordingly. That would be one way. And that way you continue to repay the same amount of mortgage principal and keep your same on the same amortization schedule that you had originally set up when you took out the mortgage in the first place. The second way, and again, it's unique to the individual, so you have to understand which option is better for you, is determine what the difference in payment is. But instead of having that payment directed towards your mortgage principal, you may consider directing that payment towards, for example, a tax-free saving account or even a non-registered investment account, and either place it into savings, or you may consider a very low volatility investment account, something that's more heavily geared towards bonds than stocks, where your principal is largely protected. But take that strategy over the next 12, 24, 36 months to ensure you're putting that money away. And if you do that, then it'll be there available to you to subsidize your cash flow if interest rates rise in the future. But the best case scenario is that your income can continue to subsidize it. And maybe that'll build up a surplus of savings that you can use to invest in the future or anything else that may come up.
Beautiful. Going forward, so we kind of talked about the amount of rate hikes that need to happen for, I guess, variable rates to come in line with where fixed rates are at right now. Where do you see things? I don't know, is a prediction for kind of the next, we're already in April now, the next 8 months to the end of the year, are we seeing rates doubling again from where we're at currently? Is that too crazy? What are you seeing?
Well, I always try to lean on those that have access to better data than I do.
Of course.
And
that's why I got you here. That's why I have you here today, Sergei.
And I appreciate it. Yeah, well, I like to lean on those again who have better data than I do and who have leading data as opposed to lagging data. So TD Bank economists right now are predicting between now and the end of 2022, another 1% hike in current policy rate. So today the policy rate is 1%. 1% more would get us to 2%. And that could be in the form of 2 hikes of 50 basis points or potentially 4 hikes of a quarter point. But there is the expectation of a 50 basis point hike coming up in the June meeting. And I think the forecast for 1% higher is very realistic. There doesn't appear to be any immediate resolution to some of the short-term inflationary pressures that we're feeling. The war in Ukraine is ongoing with no resolution, no immediate resolution in sight. The lockdowns in Shanghai have no immediate resolution in sight. And the tailwind effects, especially from, well, really both of these circumstances, are likely to show themselves in data over the next 2, 4, 6 months. So inflation readings are likely to come in higher for some time. But it's fair to assume that as our economy rebalances and more money gets directed towards service spending as opposed to product spending, more money gets allocated towards travel, consumers start to feel the effects of rising interest rates, because again, that also has a lagging factor to it. Really? I'd imagine that prices will follow their multi-decade trend of slowly reducing over time. We've been in a very long-term trend of lower prices, and I would expect that once some of these headwinds resolve themselves, that trend will continue and inflation will plateau and slowly come down over time. And I had mentioned earlier that another factor we really want to look at is how are variable rate mortgages being priced now in the market? So 12, 24 months ago, if you took out a variable rate mortgage, there's 2 components to it. There's current prime rate and then the discount to prime. So banks were offering a discount to prime of 110 basis points, 120. That means 1.1 to 1.2%. Now, if you're taking a variable rate mortgage, the discount to prime is largely diminished. So the discount now is 60 to 80 basis points on average. And what you can deduce from that is prime rate is expected to rise, but over a 5-year term, at some point it will plateau and it may even decline. And a recent CIBC research note and some other economists are starting to expect a greater probability of a recession taking place at some point in 2023 or 2024. And there's no guarantees. These are forecasts. These are not absolute things. Either yes, it will happen, or no, it won't. Right. When you're making the decision of which product to choose, whether it's variable, adjustable, 3-year fixed or 5-year fixed, you're looking at what are the probability of events, including what are the probability of events in your own life? Right. What's the possibility that your relationship circumstance may change? Your medical circumstance may change, your job circumstance may change, your necessity to move, again, based on kids, will you have other dependents, etc. So all of these are probabilistic events. Yep. And you just have to understand what's the probability that one product is more or less appropriate for me. My general recommendation, just like in most matters in your life, don't make this decision independently. Mm-hmm. Consult with those that will be able to guide you in that decision, so you can ensure that you've done your due diligence before you make a long-term commitment.
I guess on that note, Sergei, then how can people reach out to you to kind of get a little consultation action going on and kind of get some of these questions answered, do some self-discovery, some discovery with you?
Yeah, you can certainly look me up on Google, Sergei Modilevski, mortgage broker. You can find me on Instagram under DIY Finance Guy, where I'm putting out a lot of personal finance management tips and tricks. You could reach me at Sergei M, SERGEIM at dominionlending.ca. And I'd be happy to answer any questions so you can make a better decision for yourself. And
I don't know if I'm good enough to edit and throw these graphics on the screen and stuff, but I'll definitely put everything down in the description of this video for people to reach out and contact you. I always appreciate our time together in these conversations, Sergei. Thank you so much for this, I don't know how long we've been going for, 10, 15, 20 minutes. It always goes by in a whirlwind, but thank you for your expertise and for answering these questions for us.
Likewise, Rob. Thanks so much for having me.
Amazing. Okay, guys, until next time, I'll talk to everybody soon, and cheers.